Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
Okay, welcome back to the Winner's Playbook. I'm Steve. I'm here with Josh. Josh, how you going, mate?
Yeah, good, mate. Just the usual. Just another week coming to a close. What are we, about a month out now from Christmas? And yeah, it doesn't feel like it's slowing down in the slightest on my side of things. How's life and clients treating you, Steve?
Clients busy, mate. I was in Melbourne this week. Busy week in Melbourne with the team and clients, and back in Adelaide now. See more clients. So no, it's been flat out, mate. And what are the things you're seeing with clients at the minute? What are some of the key topics?
Yeah, well, there's a lot of, cost of living. Everyone's worried about interest rates and mortgages. I don't think we can escape that for the next 12 months. So that's going to continue, I think, to be a conversation point there, restructuring loans and things like that. So obviously on the mortgage broking side of thing, our mortgage broker, Eddie, in the business, he's flat out trying to keep all the clients happy and helping them out. But that's I think one of the key themes. But really all in all, it's just clients and just needing help. People are still wanting to, even in the good and the bad times, there's people need help regardless. So I think it doesn't really matter what's happening out there in the world. There's just always something that we can help people out with and add value to the situation. What about yourself, Steve?
Yeah, look, I think, the cost of living is clearly on top of the agenda. A lot of the conversations we're having is how do we sort of find some more cash from wherever it may be to pay some more bills. And it doesn't matter what spectrum of the income brackets you're on, everyone's sort of trying to find a few more bucks here and there to get through. And that probably a good segue into what we're going to talk about today, mate. It's home loans obviously getting a lot more expensive now than what they ever used to be. But the old adage about should I pay down my home loan or buy other assets and invest, it seems to be a conversation that over the last 10 years, if I look back, is a common question, I reckon, that comes out of client conversations is, I've got a home loan, do I pay it down or should I buy other assets and invest?
Yeah.
What's your take on it, mate? I think, this is a big one. I reckon it comes up a lot in our conversations, but what's your take on this position?
Yeah, I think probably one of the most frequently asked questions we would get as a financial advisor. And I think it was quite an easy one for us, go back 2-3 years ago during COVID, interest rates dropped on a mortgage, you were getting under 2%. And then I guess you always got to look at the differential between your interest rate on your loan versus, well, what better could you be doing elsewhere, which is, referring to the term opportunity cost. And so for everyone to understand how an opportunity cost works is if you're going to choose to do one thing, well, what could you be otherwise doing with your time or with your money? So if you're instead looking to pay down your mortgage, if you weren't paying down your mortgage, where could you be deploying your money? And that was a really easy equation when interest rates were 2%. And so you'd be paying down your mortgage at 2%, but, investing in the share market, and Aussie shares over the last 50 years have done on average over 9% for that period of time. So that equation was quite simple. I don't think I had any clients I was even considering paying down debt with at that stage. But now with that, your average mortgage rate sitting at 6%, you're lucky to be getting under 6% these days. That gap is closing between the other asset classes that you could be investing in. So that equation has definitely started to change, and is definitely a conversation now that's being had with all clients, is around that paying down debt versus investing. But I guess there's ways of doing a little bit of both, and it's always obviously going to come down to your individual circumstances and goals. But yeah, there's a lot to unpack there, and it really does come down to your goals. And I think it's, it goes back to a lot of that older school way of thinking as well. Is like, where does that come from? You typically hear it from your parents. They would typically tell you, if you buy your first home, pay it down as soon as you can. I know I hear it from my mother-in-law quite a lot. She's kind of freaks out a little bit when she hears how much debt that I take on and things that I'm doing in my life. But it's definitely that older school way of thinking, in my view, is, pay down your mortgages as soon as possible. But as we'll get into, like, your home you're living in doesn't even pay you any income, so you got to look at that equation. But there's a lot of key points between it. So how do you try to address that with clients, Steve, when you get that one? What are some of the key points you start to look at?
Yeah, look, it definitely is a parent, older generation thing, this pay down debt philosophy, and that pops up every now and then. I hear, oh, my dad or my mum told me to do this, and that's the way I should do it. And trying to change that mentality sometimes can be a bit interesting. I think the main things you've got to weigh up that goes into this, I suppose, formula of paying down debt versus investing is where you're at on the wealth scale.
Yeah.
Your wealth journey. Clearly, as you just said, if you just got a house, it is an asset, but that's not a retirement asset, right? Because you can't, you got to live
It's just a
somewhere. So
shelter. Yeah.
it's a shelter, yeah, right. So you got to build wealth, and that's sort of, if you're not on that journey, then just paying down your main residence debt is not going to help you probably get there. Age has clearly got to come into it.
For sure.
So if you're 50s and 60s, that's a very different conversation to 30s and 40s. By the time we're 60s, clearly we want to be sort of have that debt paid off. So that has to come into it, unless you're really outside that box. But really, what are again, the personal goals. So what's your goal and what are you trying to achieve, and that has to come into it. But in a generalized sense, from my perspective, if you're in your 30s and 40s, clearly you got to get assets. We're not going to be able to do much with life if you don't build an asset base. So
Yeah.
I've seen it way too many times where I've been meeting with clients who are on very good wages, and some of these clients are in Sydney on very, very high wages, and for 10 years all they've done is pay down their main residence debt, where I've tried to convince them otherwise, and then 10 years later we're having the same conversations and all they've got is their house, and we've missed out on 10 years of growth of, like, literally they could have had $4, $5 million, $6 million investment property portfolio outside the main residence, and 10 years later they don't. They've just got their house. So to me, that's a huge missed opportunity for generational wealth. I wish they'd listened to me, and they just didn't. But that's the way it goes sometimes. So how about yourself, mate? What have you seen out there, and what are your key things that you'd probably consider with this question?
Yeah, so I think depending on, like, if you're buying your first home, you usually put down your 20% deposit. But if you do have a lot of debt, there is an argument that you might want to get your debt down to at least a controllable level as well. Because talking about paying down debt, it's not a bad thing, because you're actually increasing the amount of equity you have in that asset. So the property's worth $1 million and you owe $800,000 originally, but then you pay it down to $700,000. You've now got more equity that you could then utilize for further wealth creation. But I'm a huge fan of using lazy equity in properties. So a lot of clients I see, they've bought their first home, they've maybe sat on it for a few years or 5 or even 10 years and just been paying down that or stuffing extra into the mortgage. But then they're building up a lot of what I call lazy equity. So as you're paying down the loan, and ideally the value of the property is going up, the amount of equity that you can then release, which is just the difference between the loan value and the property value, banks will generally let you take out up to 80% of that quite easily for investment purposes, assuming that your income, though, will be able to service the extra debt that you're going to take on. So you've got to have an income coming in with it, even if you've got equity. I've seen cases where clients have got a lot of equity, but they're earning barely anything, and they can't actually access any of that equity. So there is more to that equation, but particularly for the wealth accumulators, I'm a huge fan of using equity to leverage and speed up that wealth creation. And that could be, leveraging off the first home that they've got, maybe withdrawing. I'm doing it for so many clients at the moment. Maybe we're taking out a couple of $100,000 from that property and using that to get onto the first investment property purchase as well. So, with the help of a mortgage broker and a buyer's agent in that team, it's not something that we just do ourselves. So, we as the advisors more so want to drive that vision and figure out, like, what's the strategy they should be doing in the first place, and does it make sense to be buying, say, an investment property, but then having the mortgage broker that crunch the numbers to make sure that it can happen, and then having a buyer's agent on the other side of things for the actual property selection. But when you're in your 30s and 40s, like you said, it's all about actually getting those assets on the board and then starting to benefit from those compounded returns. Because a lot of people think of their home that they live in being an asset, which is true, but my definition of an asset is it pays you income, which a home doesn't pay you income, the home that you're living in. It goes up in value. So, yep, your home should be going up in value. But then there's also the other key point of good and bad debt as well. And then the home that you're living in is bad debt, because none of that debt is tax deductible to you personally, and you're just paying it all yourself. Whereas if you had an investment property, all of that debt, so the interest associated with your loan, is tax deductible and is a good debt as well. So I think understanding the differences between good and bad debt and how to use those to your advantage, and not being afraid of getting into good debt is an approach that I really do like to adopt with my younger clients. What would you add there, Steve?
Yeah, look, totally agree. And I think people have options, right? Like, where they're going to invest. It's not just buying other properties. It's probably
Yeah,
buying into businesses, right? I know
yeah,
you've done that yourself. It's just about building wealth, and as advisors, we're not limited to any way to build wealth. There's heaps of ways you can build wealth. So you can use that equity to invest in a number of different things to make money. But yeah, I think it's just getting that mindset. We speak about mindset a lot, right? To open up the options and realize what you can do with your money to get on that journey. So
yeah.
if you're sitting there, Josh, and you're listening to this podcast,
Mhm.
and you've got your house, and you haven't yet gone outside that particular asset to invest.
Yeah.
What are some of the things you should be thinking about? You think, and what are some of the things you should go through to get on that journey?
Yeah, the way I really want to approach it with clients is, first of all, look at, okay, if we've got some equity in there, like, what's your maximum borrowing capacity is always a really good
Yeah.
starting point. So the first thing I always want to assess with the client is, how much could we borrow here? And let's just say you could borrow another $1,000,000, let's just say, as an example, on top of what debt you've already got. All right, great. That's our starting point. That does not mean we're going to go out and borrow $1,000,000, just to be clear, but we know what we're then working with. And then I tend to work it back from there and go, okay, what cash flow is coming into the household now? What free cash flow do we have? So what's the money left over after all of our expenses are paid? And there's generally a lot of work that we do with our clients around optimizing their cash flow and rearranging that to get more surplus. And then with that, that's really how I then sort of direct, all right, what's a safe sort of property? If we're talking property, how much property could we be buying here, because we're going to be able to service the loan on that additional mortgage that we're taking on. But it again, like you said before, it doesn't need to just be property. It could be taking out a bit of equity, and I've done this myself, to invest into shares, and investing into the share market, or an investment portfolio of managed funds or ETFs or indexes can be a really awesome strategy as well. And there's a lot of pros of doing that versus going into property, because property, you don't get really any diversification. It's just one single asset that you're acquiring there. Whereas you could take out $100,000 if you've got that equity, and maybe you put that into an investment portfolio that gives you exposure to 1,000 companies in Australia and around the world. So there's definitely an argument for doing that, and I definitely like using the share market. I think nearly every client I work with in the wealth accumulation phase, they've got property, but we're also heavily investing into the investment markets, shares, and managed funds. And talking to that, Steve, like, what are some of the, like, if you look between property and, say, shares, or those types of investments, what are some of the pros that you see of, say, going into shares as opposed to buying property?
I think, as you just said, the ideal world is both, right? Like, you
Mm,
get that ideal diversification. You're across all asset classes. You've got liquid assets in terms of shares and managed funds, right? So
yeah.
you can call on cash if you want to, but you're invested in the market, so still building wealth. Then you've got a capital base of property that's leveraged up to give you that scale, and that's a powerful tool. I know I've done it for myself.
Mm,
And it works unbelievably well to build wealth for you and the family.
yeah.
What I've seen work well with clients, is exactly that. Like, generally, people get on the property journey first because that's naturally what banks like lending to.
Yeah.
But once you've got one or two properties outside your home, then you can really open up the floodgates about options, right? Then it's about what
Mm,
else you can invest into, as you said, managed funds, ETFs, and the best clients that I see success with this, and they're not high, they don't have to be earning lots of money to do this. This is open to everyone.
yeah.
Is definitely going then right into business, increasing incomes that way. Managed funds, ETFs that increase your incomes through passive income through that as well. So that's definitely the strategy that works, is diversification across really all asset classes. And I think the other thing that people have got to keep in mind too is that taxation advantage, that people get when they're, lending off for investment purposes, being fully tax deductible, while we don't invest in a particular anything for just tax reasons. And I think that's very important to highlight, no investment should be just for tax reasons.
Yeah.
But if you combine the tax reasons plus the passive incomes plus the wealth generation, that's, a really, really powerful position to utilize.
Yeah, and I think the big difference between property and shares as well is the leverage you get with property, and that's why it can be really appealing for a lot of people. Because say you have, $100,000 or $150,000 of cash, or you've pulled out equity, as an example, you could take that money and go and buy, say, a $600,000 property asset. Whereas if you're trying to do the same thing with shares, yes, you can leverage to an extent, talking about gearing and going into some geared funds and margin loans and so on, which are not something we typically get into with clients because that stuff's incredibly risky. But with going into property, you obviously get that leverage, so you can own a total more amount, like a larger amount of asset with the same amount of contribution. So that's why, you usually that can be a really good option, but you definitely don't want to neglect, the shares. And, I do both. I proactively invest every single fortnight. What money comes in, a portion of that is going to my investment accounts every single fortnight, but it's a more passive strategy. I don't have to think about it. Like, there's no tenants I'm worrying about with my share portfolio. So that's, again, some of the benefits of going into shares. Like, you don't have to worry about, your interest repayments. You're not worrying about tenants kicking holes in your walls in your, in your property. You're not worrying about, I had a client tell me the other week, who's a property manager, about a tenant burning the house down. And so you don't have to worry about any of that with those types of investments. And that's like a bit of that, you hear about, like the sleep at night test. Like, you don't want to have to be thinking about your investments. And that's like for some clients, buying a property is just actually not a good option for them. And they don't want to have to think about or worry about a property, have it being managed and so on, and can just well and truly achieve all of their goals by investing in a, well-diversified portfolio over the longer term, and not even having to think about it. And it's all just happening in an automated fashion. So
yeah, 100%. And then that creating that passive income over the journey, right? It's such a powerful tool, and having that idea that, what if I don't have to work next year because I got this other income coming in from managed funds and exchange traded funds and a few shares. That's a pretty strong position to be in, right?
Yeah, I don't think you're going to get create wealth, or be rich, if you want to call it that term, by paying your home. Paying down your home loan's not going to do it. It's not that in itself. Like, it's good to do it, but that's not going to create wealth. And all of the the real wealthy people out there, like, they are using debt to their advantage. Is what they are doing. And again, the way I usually approach it with those clients is, all right, we're going to be taking on debt probably for a period of time here, but then at some point in time, we're going to start to extinguish that debt, which could be offloading property, because property is generally not that great of a asset in retirement, because it is, it's illiquid. You can't just take $5,000 or $10,000 from here to go for a holiday when you get to retirement. So it can be a really good wealth accumulation vehicle, property, in my view, but in retirement, it's generally not the greatest. And that's where we do obviously look at things like superannuation and investment portfolios, where you're a lot more liquid. You can take money out of it, but it's also providing you a passive income. But what about when you have clients then getting up into their 50s, Steve? So are you starting to then look at proactively paying down some debt at that point in time, or do you look at some other strategies of maybe taking money out of super once they're over age 60, or what are some of the things you've done there in the past?
Yeah, it's probably just more of a balanced approach. Like, I think 30s and 40s, it's just gear up, go for it, get your assets, get multiple assets, and go all in.
Yeah.
50s, late 40s, 50s are probably a little bit more balanced, where, you will add up and juggle out paying off debt versus investing versus passive incomes, etc. So, clearly, and that's where an advisor can really add lots of value, is when do you pull those triggers to balance it out, right? Like, that's where we really step in and add a lot of value, because you give people that pathway through to their late 50s and 60s, and have that plan in place to have them debt free, right? So, but if you've got multiple assets, in your 50s and still have debt, that's totally fine, because then we can maybe sell one of those assets at the late 50s
Yep.
and pay off the debt. So
Yep.
as long as we've got the asset base of whatever it may be, and that gives us options, and as long as we've got
Yep.
options, then it doesn't really matter. So it's not like
Yep.
I go hard and say, right, you've got to pay this off at a particular point, because if I've got an asset I can sell late 50s and clear out the debt, no
Yep.
problem, right? So
Yep.
yeah, but also, as you alluded to, superannuation starts to kick in at that point, because by 60 we can access it. So if we're going hard on super in our
Yep.
50s, which we should be, really go real hard at that point, then at 60, even if you're still working, we might be able to cash some money out of super and just pay off the debt that way as well. So, there's plenty of options. And I think that's the key message out of this chat is there's so many options that we can play around with. And it's just decking out what option suits which client, really.
Yeah, because it doesn't just have to be as simple as paying down, debt in your late 50s. Like I've done some advice for a couple of clients in the last few years where they're sort of 10 years out plus, or 10 to 12 years out from retirement. They've just got their home that they're living in, maybe 200-300K owing on it at the moment. And then we've looked at, all right, should we be smashing all of the cash flow into that mortgage now for the next sort of 10 years and be debt free there? Or would we be maybe pumping money into superannuation, getting some tax savings from that in the meantime, but then also getting compounded returns, of which we anticipate and have been higher than their mortgage interest rate. So they're getting typically 8 or 9% in their superannuation. And then that compounding over a, say, 10-year period versus just paying down their mortgage. That's actually how I've addressed it for these guys. And then by the time they want to retire at 65. So at 65, we're then going to take a tax-free lump sum out of their superannuation and pay off the small amount of mortgage that would be owing at that point in time. So yeah, like you said, it's just 1,000 options out there, and it's just trying to cut through that and figure out what's going to be the best option for you, because what suits you is definitely not going to